I'm really excited for this panel, Crypto Venture Fund. So we're going to have a lot of fun with this one. We only have 30 minutes, so we'll make it as entertaining, provocative, and
We'll talk really fast.
And really argumentative and controversial as possible. So
good.
Why don't we start with Patrick, since you're on the line over there, to make an introduction about your background and your approach with crypto investing.
Okay, thank you. So my name is Patrick Martin. I'm the managing partner at European Media Finance and also at the new technology holding that we recently set up in Bermuda called Atlantic Digital. My background is I'm a lawyer, a German lawyer by training, and then I joined and ran several tech and media startup companies, IPO'd 3 of them, and then became angel and venture investor. I've been investing in technology, media, entertainment companies for the last 25 years, and then for the last sort of like 24 months, I've been getting more and more interested in blockchain and crypto, and that's when when you go in, it's very hard to turn back. So I've been focusing on this basically exclusively for the last 18 months, and it's been interesting. So happy to contribute, happy to be here. Unfortunately, I couldn't make it in person, but at least I can participate remotely.
Great. Chance?
Hi, I'm Chance Barnett. I currently run a crypto hedge fund called Decentra Capital. First and foremost, I'm an entrepreneur and builder of companies. That's what I love doing. So I would call myself accidentally in finance, because I got into finance because I love building companies. And when you don't know a lot about finance on your way, you're taught some hard lessons as an entrepreneur. So took some of those early on. I've founded or co-founded, I guess it's 6 different companies over the last 16 years. That ranges across quite a few different areas, from ad tech to fintech to then later blockchain, and also specifically in the venture capital area. About 9 years ago, I played a role in a legislative initiative in Washington, D.C., and that was a small group of people that participated and gave input and helped support a portion of legislation within what was called the Jobs Act. So the Jobs Act kind of gave birth to the equity crowdfunding industry in the US. I started a company in that space during that time called Crowdfunder, which provided early stage startup finance. Launched a venture fund around that. Got into blockchain after investing in a whole host of blockchain-based startups 3 or 4 years ago. And if you're writing checks regularly into early stage deals, the 1 or 2 funds that were very active really liked you. So I made friends pretty quickly with a lot of blockchain investors, and they started doing this crazy thing called cryptocurrency, and I was, wow, what's that? Had 0 holdings. Fast forward to today, and that's all I focus on. I have a fund and working on something that I can't talk too much about in the banking and payment space. So, longest intro ever.
Great, awesome. So why don't we go into the heart of the topics in the investing space of crypto. Starting broadly, what kind of investment themes or thesis that you guys find really interesting in terms of what is the vision for the whole stack of technology that we're building? So from the we heard earlier a technical explanation of consensus algorithms with hash graphs. So there's those kind of public blockchains, layer 1 solutions, very technical operations, and the endogenous tokens that are kind of true cryptocurrencies, if you will, that are used to incentivize the maintenance of public blockchains. And then we're seeing, as the application layers get built on top of those layers, there's things that are called dApps that are they're kind of centralized business applications that might use a blockchain layer, or they're trying to totally decentralize their business models, and then there's infrastructure that sits between all of those. So it's really become rich, and how do you guys make sense of all of those pieces in the ecosystem as it's developing, and where you think value is going to accrue? I'll start with you, Patrick.
So, well, I think that as you were saying, the industry is evolving rapidly to include more and more sectors, and it's very interesting for me to see blockchain technology being applied in lots of different sectors. Especially one of my sort of background sectors is media entertainment, so there's a number of companies in that sector, and I think that the theme of today is the crypto venture capital. I think that the traditional venture capital firms have not really participated to a large degree in this sort of new asset class, because mostly their fund setup is not allowing them to hold tokens instead of equity. So that's been a problem for them. But I think there are various ways where they're trying to remedy that at the moment.
Okay.
Sorry.
No, it's yeah.
Yeah. I don't know if I answered your question,
No.
but that's kind of
Good. Chance.
Sure. I in some ways break up the market in 5 rough buckets that I look at, that I think of as core layer, not necessarily infrastructure, but at least layer 2. So I don't know if everyone's familiar with the model, layer 1, layer 2, layer 3, the kind of DApp layer for blockchain ecosystem. But in short, I look at 5 main areas. The first is connectivity. So how are people accessing the web? Are they doing it on a mobile basis? How will connectivity change as there's distributed models? And so, I think Stan mentioned mesh networks and the like. That's an example of something in a connectivity space. Also look at computing. So how can you have distributed computing models that lower the cost, allow larger people to participate in that? That's an example in the distributed computing areas. How is computing going to be transformed? Banking and payments has gotten the most of my attention. In fact, I invested in a company and now come on to co-found it in that space. I think that's some of the biggest core infrastructure of our economy that's going to be transformed. And you've probably heard of the Citibanks and all the large banks and the like talking about how they're testing blockchain. I think 2018, 2019, 2020 are the years where those things come out of tests and things are pushed into the market. And we're even seeing the larger regulators, like the bank regulators in the US, starting to act and put out policy. That's probably coming in the next couple months. So that's a particular interest. That's a third. Generally, I think of things like energy as resources, and that's a bucket. So how can you fractionalize them? How can you have people contributing? How do you create a shared model on blockchain? And then the last one is kind of more pure finance. Not that I want to avoid the social layer, the entertainment, all of that. It's not my expertise. It's not what I know. Patrick has a great background in that. I like to invest in what I can kind of help and understand. So those are the main buckets for me.
Great. So, Patrick, you mentioned that traditional VC funds have not been able to invest in token projects because of restrictions in their fund where they are required to hold something like equity, and that's changing. So I want to tease this one out because there's huge debates about where value accrues, and of course there's a regulatory aspect to this as well. As many people know, the big question is what is a utility token? What, in terms of its substance, its design, its model, its usefulness, its actual utility. What does that mean? How do we define that? There's the regulatory shadow over what is the category for this thing. Is it actually just a security in disguise? And now we're introducing equity back into this story. So again, more a beautiful mess in terms of how do we figure this capital structure out, and where investors see the value accruing to them, what types of instruments investors want to hold. Because a lot of, we had this debate during lunch where we're saying, okay, you've got this utility token and equity, but it sounds like I'd rather just hold the equity because it sounds like most of the actual enterprise value or network value actually accrues to the equity rather than tokens. So can we parse that debate out and kind of introduce the debate there?
I think we can try, but in the context of a couple minutes for the question, it'll be tough. But Patrick, please take it first.
Yeah, sure. I mean, I think for the difference between, traditional venture capitalists, I would say they are set up to invest in private equity, so in companies that are not listed anywhere, so that they're not liquid, so that they're basically investing in early stage startups and growth companies before they get listed on exchanges. And I think part of the thing, especially in the US, most venture companies are not supposed to hold more than 20% in liquid assets. So even after the companies they invested in, once they go public or become liquid, then they should be selling them off. So in venture, in the crypto space, a lot of companies are issuing tokens which are not equity, but they're basically a right to use a service that the company is building or has built. So think about airline miles. If you're basically American Airlines or the British Airways customer, basically you're not buying shares in the company that owns the planes, but you're buying air miles to use the system to basically have points that you can use to access the flights, but you don't own the underlying assets. And this for a venture company is problematic because in their agreements with their limited partners, with their investors, they basically are supposed to hold equity that also gives them governance rights, and basically maybe in the worst case actually fire management and replace them with other people. And in crypto, especially when you're talking about utility tokens, which have access to the network, this is not possible because you're investing in a technology layer and not in the company that owns the technology layer. So this is one of the problems for venture capitalists, which is being mitigated now by either they ask to invest in the equity of the company and then maybe get the tokens as an add-on. That's one solution that I'm working with when I invest in new companies, where I'm saying, okay, give me equity in the company as well as tokens. Another option is that they change the agreements with their LPs, their investment agreements, and say, oh, give me a right to take maybe 10 or 20% of the capital that you gave me before to invest in this new form of asset that is definitely an asset, but it's not equity. So that's the second solution. And the third solution, which some venture capital firms have in the last year, they basically started investing in crypto venture capital funds or crypto hedge funds like Chance's fund. So they basically say, well, we can't hold equity in the token is not equity, but the company that invests in the tokens, like a fund, that's equity. So I'm now allowed to hold it, and indirectly I'm getting exposure to the market. So those are the three solutions that they've been employing so far. And the fourth solution is basically saying, I'll set up a separate fund where I'm raising a separate capital bucket. This is what Andreessen Horowitz did, and they just raised $300 million, especially for investing in crypto and assets like this, right? So that's the state of play in the traditional venture funds, but they have not been able to really capture a lot of value in this.
That's very helpful. Thank you, Patrick.
So that is the structure, or leaping off of what Patrick said, I think that, well, there's ways to look at this structurally. Just to touch on what he said, the market has moved in an incredible way about how investors are investing in this space over the last year and a half. A year and a half ago, token sales, money rushing in, just wanting a discount, all in, crazy frothy, stuff was popping, there was liquidity everywhere. It was a really crazy time. Very quickly, with potential risks, the SEC putting their foot out a little bit and saying, hey, slow down, wait a second, we're concerned about this. Things rapidly moved offshore and have continued to do so. The US market slowed down as of 3 to 5 months ago considerably. There's some notable funds that said, I'm done. My fund in the US is done. I'll happy to say my fund that I just invested through that was a US fund, I'm pretty happy that's done, and I probably won't open another crypto hedge fund onshore for a few reasons. But more to the point, I think deal structure has evolved, and generally what I'm seeing or what I'm helping companies do is have a combined issuance of both equity and tokens. But to the core essence of your question, I think, which one's better, where is value captured? I'm always greedy or flexible, however you want to look at it, to say in both areas. I want my cake and I want to eat it too. I want to be a part of the core value accruance to the enterprise. I want to see great assets there. I want to see that to be long term. I want to see a great management team. And I want to see a real model that's unique in a token that couldn't be solved with something else centralized, meaning it's an advantage to be a blockchain, not a tool to raise money by issuing a token. And to that be an asset that can grow as a core model of whatever IP that the core equity issuing company has built. And so I love the combination of being able to grab at equity and get tokens, as I would call it a sweetener often, but it's got to be the right company. So the first question I ask always is, why is blockchain better than a SQL server? So how is this being decentralized an advantage over everyone else in the market? And if I can't answer that, there's no way I'm going to care about the token actually or the equity. So I think it's intrinsically tied. That's my perspective.
Let's tease that out a little bit, because I think there's a lot of interesting stuff in there, and so this will get juicy. So I'll give you my view. I think it's very difficult to find a rational token model that makes sense in terms of why that's an additional value that it's unlocking, right? And as you said, why this database, and it has to be more than just, I'm a member of this little social club and it gives me access to services, because then it's like you could just have a regular SaaS subscription or a regular revenue model. So it has to be something about an innovation in terms of why decentralizing the business model, or why that particular network is important to have participation across different stakeholders, across silo databases, right? So can we give some concrete examples so that helps people understand, here's something where tokenizing X layer and creating an entirely new business model, decentralizing and melting away the traditional boundaries of that business model makes sense, and what I think the value is going to be captured there, which is somehow distinct from the equity that is being captured by this company, and what is the role of this company vis-a-vis this new decentralized child that's created, right? So if there's some concrete examples that you can give.
Sure, I'm happy to jump in with the first concrete example. And I want to push one area of the entire market aside and say it's its own unique thing, which are currencies. I think there's a clear case for that they're not securities, they have a different function. I think peer-to-peer currency like Bitcoin that's totally decentralized has a really important purpose. And I would say it would be very hard to do anything like that without a decentralized, tokenized peer-to-peer model. But that's a structural construct, and currencies are separate. So if we're talking about tokens in a core business model, I think Ethereum and Ether is a really simple example, and probably the only true scaled enterprise model. So it's a good example, and one that everyone generally knows. Gas is paid on Ethereum with the token. That is, in part, the core initial reason why there's a token on Ethereum. It's to pay for the computing services that are rendered. So if you want to build an application, you want to do a transaction on Ethereum, you pay in Ether. It became a very useful, interesting model to then hold Ether. If you're building an app, you have to hold Ether. If it's on it, you pay using it. And then if people want to contribute, they want to participate in anything you built on it, they can use that core coin. That's also served as a two-token model where on top of Ethereum with the Ether token, you can do an issuance of your own token, i.e. an ICO, and have an ERC20 token, and build your own application that utilizes and has value. So I don't want to get too far into ICOs and that being the only application on Ethereum. There's a lot of other cool stuff to do with it. I think it would be really, really hard to have built a developer community of 200,000 active developers, or at least registered developers, have a worldwide phenomena that's totally decentralized on building this, and have a core incentive model where people are paid and pay in unless you had a shared token or currency. I just don't see how anyone would do that. And then it lends itself to decentralized models that leverage on top of it. So the token becomes at the center of an entire new collaborative or shared economic structure. And so I think when we look at tokens and utility tokens through the lens of, and I can be guilty of this too, through the lens of people in finance, or if you've spent time around regulations or the SEC, when you're a hammer, everything's a nail. So you can't help but look at things where people are making profits and say that has to be a security. I get it. But there's different new things in the world, and regulators around the world are being tasked with trying to grapple, okay, it might have equity-like structures or qualities, but it's a different animal. So I'm reminded of the old adage about, there's three people standing around an elephant, and they're all blindfolded, and they're asked to describe what the elephant looks like. And one person's touching the trunk, and they're like, oh, it has this big, long, weird thing, and it curves, and it's kind of fuzzy. The other person is touching a leg, and it's like, oh, it's got this column-like features, and the other person's touching the tail, and none of it can see what it is. But as a whole, if you were able to envision the whole thing, you would, oh, it's an elephant, really clear. So I think that's what's happening around the world, that we're all trying to understand our relationship and these new kinds of models. And I also think it's transforming the ways that people can participate and collaborate. Opportunities to build, opportunities to make money, opportunities to be a part of economies that couldn't have been connected and shared previously across international borders, which is really exciting, I think.
Yeah. Patrick?
Well, I would say yes. I mean, it's very important to define that a token has a good use case. I mean, one thing, if you're having a consumer application, I think the thing that drives adoption is really, it needs to be cheaper, faster, and more convenient. Those are three very important things. And I think what blockchain enables is a transfer of value through a decentralized mechanism, and it can also be used for payments in very small denominations. So basically, it's kind of speed of payment and enabling incentives. This is kind of why Bitcoin works, right? Bitcoin works not because anyone is running it, but because there's an incentive that if you give me computing power and you give me electricity, then I will give you Bitcoin, right? And so this is a very powerful incentive, so that you have now thousands or tens of thousands of people running servers and giving electricity and computing power to Bitcoin because of the incentive. So the blockchain is a very good system to distribute incentive to the place where it needs to be. You can build a network where you basically have incentive going from one place to another without having to pass through a centralized entity that might become a bottleneck or let's say a bank, in terms of if you're doing international money transfer, you don't necessarily want to pay $50 to the central bank of your country in order to process a transaction. You just want to send $100 to your relatives in the Philippines. So these are, I think, very good use cases for blockchain technology, but it needs to be looked at. And there's also a lot of companies that are basically just trying to use a blockchain and an ICO to raise money quickly, and those we need to try to avoid, or basically say, if you have a good business model and you don't need a token, then you should have one. So that's it's important to distinguish those.
Right. So what I'm kind of hearing from both of you guys, sounding out something that's been articulated by guys like Union Square Ventures and Polychain as the FAT protocol thesis. So the lower the layer you are, so you mentioned Ethereum. So Ethereum is a public blockchain, Bitcoin, public blockchains, right? So they're at the bottom of that base in terms of the tech stack. And the FAT protocol thesis says, well, whatever we're building at the base layer, all the value is going to drip down. All the stuff that gets built on top is going to drip down, because if you build applications on top of Ethereum, you're going to need a whole Ether to pay for gas. Bitcoin, not so much the applications, but it still has this protocol layer that's generic, right, for payments and so forth, so you're going to need Bitcoin. So I'm kind of hearing this, and then now there's also like new theories. I say, well, actually, that's a little simplistic, because business models are going to develop on top of that, and the leakage isn't going to necessarily leak all the way down to the bottom of the layer. So how do you guys think about that narrative?
I know we have to wrap up kind of soon, so I'll keep mine brief. Look, I think we're remaking portions of the kind of internet 1.0 and 2.0, and there will be value at all layers. The people that got to invest in the core computing layer of the original 1.0 and 2.0, a very sure win, and then it's probably harder to pick the hits businesses, the hit movies, features that come on top at the higher levels. But I think value will accrue there. But if you're looking for returns in this market, it's a much safer bet to be lower down because, and to also serve the crypto community. There's very little that is commercialized and profiting and returning well that doesn't serve the crypto community. So it's very insular right now. That's going to change. I think 2019 will really be the year where we'll start to see enterprises. So I think there is value accrued elsewhere, but it's when enterprises come in, not how can we build something cool and redo some dApp that already exists that's not tokenized, and then now we're tokenizing it and saying it's better because, hey, everyone wants to use the crypto. Yeah.
Patrick?
Well, yeah, I would say that this is, I agree with Chance that, I mean, for the fat protocol layer, I think that the theory for this goes that you say, well, you're not actually investing in the technology, but you're actually owning a piece of the technology. So that's kind of the point where you're saying, hey, if you need to use this technology, I have I have a little piece of it, and or a big piece of it. If you want to use it, you need to use my pieces, and I get something in return, or the price goes up. The more the network grows, the more people want to use my pieces. Let's say in the case of Bitcoin, you only have 21 million pieces, and if 500 million people want to use it, and they want to own one each, then each one is going to be very expensive, right? So that's kind of that's the theory of the fat protocol, that you say that the base layer accrues more value than just sort of being a technology that everybody can use for free. The argument against that is that basically if you have a layer of a protocol that is very good to use, but it's getting very expensive to use it because the usage goes up, then you also say, well, I can just make a copy of this protocol because most of these things are public domain, and I just make what we call a fork. So you basically just take the same code, you copy it, and then you basically do something that's maybe a little bit different, and then you have a copy of the code, and then you have something that does exactly the same thing. Let's say Ethereum, as the Chance was saying, there's also Ethereum Classic, which is exactly the same as Ethereum, minus the ICOs, but it's the same protocol, it's the same layer, and it works in the same way. And, you know, if Ethereum gets too expensive, then people can say, well, I'm going to use Ethereum Classic, it can do exactly the same thing, but the token is 20 times less expensive. So the fat protocol theory will only hold, I think, for a while, because then if you say, well, I can copy the protocol, so I make my own protocol and make it do what I need it to do. So it's you know, that's not I mean, it's a good thesis in the beginning, but there is potential proliferation of protocols. And so I think only a few protocols will basically be there where you say, okay, this is the one and only. Like Bitcoin is one use case where you say it's a store of value. So basically we use it for money transfer and store of value. And it's the biggest one, and has the most liquidity, so it's very likely that it will stay. But a lot of the other ones, it's unsure as to what's going to happen. So I'm also very interested in investing in applications that use the blockchain technology, that not rely on the value of the token itself for the usage, but also sort of maybe the token is paying a dividend. Then it becomes a security. That's then a security token. That's very similar to buying a piece of equity. It's just a new form of investment, and that I'm much more focused on equity-like structures now than on just sort of the protocol layer and the utility token. And you need to have a very good use case to actually say why do you need another.
Awesome. That was a great way to conclude the panel. Thank you, guys.